Welcome to Venture in the South. These are the stories of innovation and success in the southern U.S. that make money, have fun, and do good.
I'm David, and I'm here with Paul today, and we're talking about three critical issues for investors and also to founders. It relates to funding from non-diluting sources and also tax benefits for investors that are critical for founders to harness because of its attraction to investors. And so we're going to talk about the SBIR program, which is a small business administration program for funding private research on a government budget. So the government has a stake in R&D in the private sector because it generates economic growth, and they recognize that. And so that's the purpose of the SBIR. And then the second thing we're going to talk about is the QSBS, capital gains exclusion, which is very attractive for investors because if you have a successful startup and you exit for, say, 5, 10 or more X multiple on your investment, you have a pretty substantial capital gain. You can completely exclude that from tax if all the rules for the QSBS are met. And they've recently been loosened. And so we're going to talk about that. And then we're also going to talk about the H1B visa issue because there's been a lot of changes there and a lot of talking heads talking about it. And so we're hoping to bring some clarity to that. And so does that sum it up there, Paul?
It does, yeah. We're going to tackle all those three topics. We've got a couple of guest experts to join the show too. So we're going to hear from a couple of the practitioners in those spaces, in the SBIR space and the QSBS tax space, to give us some informed opinion about this stuff. And we're going to talk about it ourselves as well. So for the first snippet, we're going to talk to Mike Carnes, who is at the NC Biotech Center in North Carolina. And he's going to tell us a little bit about what's going on with the SBIR program. On this segment, we're going to talk a little bit about the foreign risk challenges that applicants to the SBIR grant program are facing at the moment. And to do that, we're bringing in some expertise to the show in an unusual change to our normal format. And so Mike Carnes is here from the NC Biotech Center to tell us a bit about what he does, what the center does, and then specifically about what's going on in the SBIR program world. So Mike, welcome to the segment.
Hey, Paul. Great to be here, and thank you for hosting and inviting me to be part of this.
Yeah, well, thanks for the work you're doing on this. Maybe just to give viewers a little bit of background on who you are and what the center does would be a good way to start.
Absolutely. So the North Carolina Biotechnology Center is a nonprofit organization in North Carolina that receives funding from the state of North Carolina. Our goal is to help grow the life sciences in North Carolina and make North Carolina the global leader. We do that in a number of ways. One way is by recruiting life science companies to North Carolina. The other is helping those companies that are already in North Carolina, helping them to expand. And then the secret sauce for the state is making sure that we have the workforce available to work in those jobs that these high-tech industries require. And so we do a lot of workforce development as well. The side of the house that I'm on focuses primarily on research, innovation, and commercialization, as well as startup company development. And so I lead the Emerging Company Development Program. We receive funds from the state of North Carolina that we invest into about 15 to 20 companies per year. We'll do about $350,000 to $650,000 per company. And we go through a quarterly process for doing that. And the goal is really to help position innovation-based companies, to help them to hit key milestones that are going to help them attract follow-on investment capital. So over the lifetime of the program, we've funded over 250 companies. We've put over $65 million out on the street. And those companies have gone on to raise over $8 billion in follow-on capital right here in North Carolina. So great economic return. I think NC Biotech is a great example of how technology-based economic development works. And I'm proud to be supporting companies here in North Carolina through these programs.
Okay, got it. Thanks, Mike. Yeah, we have invested after the NC Biotech Center and alongside, I think, on some deals. So glad
Absolutely.
to be a co-investor with you on some things.
Yeah, it's great to do that.
Maybe you could just give us a quick intro to the SBIR program for people that aren't familiar with that, and then we can talk about some of the challenges we've been facing recently.
Sure. Yeah, absolutely. So, I've been the majority of my career working with early stage companies, and the SBIR program has been an absolute critical part of that. This is early risk capital that goes into research and development for helping to generate data, do product development, and again, hit those technical milestones that are going to help companies to attract follow-on investors. Really important program. Many of the companies that we fund through our program will have already received some SBIR funding, and it's great early technical validation for investors. And I know a lot of your audience here, they're investors, and so I'm sure you all feel the same way about this program. But again, when you're going into due diligence and the NIH has already thoroughly reviewed the science and technology, that's always really helpful. But it also provides, cost sharing for early research and development and offsets the risk for investors. One of the things that I think has been really a good use of SBIR funds for companies that are equity backed already is, often we'll see companies that have their primary product that's the focus of investor dollars, helping to commercialize that first product. But the SBIR program is a great way to raise some additional non-dilutive capital that can come in and help develop another product line, kind of expand market opportunities so that you can drive additional revenue, additional value into the company in preparation for an exit, let's say. So a lot of really great value in helping to translate research from university or other early stages into commercially successful products right here in the United States. And there have been, dozens, hundreds of success stories of companies that have really hit it big after raising money from these programs. Other great thing for investors is non-dilutive fundings, investment that's already been into the companies.
Yeah. I hadn't realized the scale of the dollars that had gone through this program. So I was reading recently, North Carolina last year, it was $125 million, I think, in 100 and something companies that had got an SBIR grant, not just in the life sciences, but across a range of industries.
That's right. So just in the last year, you're right, we did some research on this, and I think 187 awards came into North Carolina, right on the nail on the head there, with 124 companies that received over $124 million in total funding. But also, from an economic development perspective, these programs drive jobs. There's almost 1,900 people employed by the companies that received SBIR funding last year. And so, that's a big deal. And then, of course, for us, we're focused on the life science industry. And over the past 5 years, companies that have previously raised SBIR dollars have gone on to raise over $4.3 billion in follow-on capital right here in North Carolina. And that's just our state, right? And so you can imagine across the country, the impact is even larger. And when you think about, from a life science perspective, when you think about the impact on human health, there was a report that the NIH put out that between, I think it was 1996 and 2020, in the year 2020, that like 12% of the drugs that were approved by the FDA actually had at some point been funded through the SBIR program. And then like over 2,500 medical devices that were approved during that time also had funding from SBIR. And so, I mean, these programs have a real impact on human health and translation, getting these innovations to the people who need them.
Got it. So what has been the challenge recently that we're talking about today?
Yeah, good question. So the foreign risk issue is one of the big items that we've been experiencing as we've been working with companies. I think it's important to contextualize this issue by just giving a little bit of history. So the SBIR program has to be reauthorized every few years. Right now, it's every 3 years. The last time this happened 3 years ago. There were a few examples that came up of companies that had apparently received some funding from foreign countries or may have had some foreign ownership, where once the federal government had put some dollars into the SBIR program, those companies went to China or went to a foreign country, or some of the IP was stolen. I think only there have been a few of these examples, certainly a very small portion of the overall companies that have been funded. But as a result of that, a foreign risk policy was put in place the last time they reauthorized the program in 2022. So a lot more focus on identifying any potential foreign risks through a due diligence process that was put in place. So that came into effect 3 years ago, but we hadn't really seen any examples of this happening back in November, December timeframe of last year. I received a call from one of our portfolio companies, and somebody said, "We've received notification that our award that was supposed to be funded is being denied, funding due to foreign risk." And I was like, "Well, what is that?" Wasn't even familiar with this yet. And we did some research and learned about the foreign risk policy and the what could be a potential flagged as a potential foreign risk. And this company, unfortunately, we couldn't identify any potential foreign risk. So then the question became, well, how can we get some information about this? And it turns out that it's very difficult and or impossible to get any information. What happens is companies are essentially flagged for foreign risks after they've been basically told they're going to be awarded and have scored very well on the SBIR. So it's doubly disappointing because you've scored very well. And then you find out that that you've been flagged, but there's no feedback that the agency can give you in terms of what caused the risk, and there's no opportunity to appeal. You don't know if you reapply of whether or not there's going to be any funding available. So it's a real challenge in navigating the program, and there's just no transparency there, which is what's so difficult for companies that face this issue. For the past, I'd say 3 to 4 months, we've seen a real uptick increase in the number of companies that are being flagged for foreign risk. We're aware of 9 companies in North Carolina now that have been flagged for over about $15 million in total funding that's been lost, again, after the companies had been notified by the agency that they're in the final stages of getting funding because they've scored very well. And again, with no opportunity to remedy, and it's kind of like better luck next time. But then the companies, again, don't know if there's an actual foreign risk or whether or not they reapply, they'll be able to receive funding. The good news is we do know of a couple of companies who were able to reapply and did end up getting funding the next go around. So companies, there is a process by which you can go back and still get funded, but that delays your program at least another cycle. That could be, an 8-month delay in getting those funds in, and you have to go back through the competitive process again. So you may not score as well. It's a real challenge for companies. And I think it's a situation that we need to make folks more aware of, because it puts companies in a bind where they can't manage their cash flow. They have to reprioritize their use of funds. We've seen companies have to raise bridge rounds and things before they thought they were going to need to raise bridge rounds, which is always a challenge. So I think just bringing more awareness to the situation is important.
Is there any commonality about what the companies do? Is it an industry specific challenge, or is this across the board?
There was a report that was put out by the Small Business Committee in Congress through the Senate, through Senator Joni Ernst's office. And in that report, they looked at denials due to foreign risk over the prior 2 fiscal years, which was really before we saw the major uptick. So I suspect it's kind of lagging a lot of the more current data. But what you see in that is that some of the agencies are taking flags and doing more denials based on those flags, whereas some agencies would flag companies, but then not deny. And then NIH, for example, everyone that was flagged was also denied. The agencies may be administering this program slightly different, and it's unclear what that diligence process looks like across the board. But the key triggers for this can be commonalities across industries. So foreign ownership in the company. So again, we don't know any specific causes for any of the companies that we're aware of. We can only speculate. Maybe some LPs and some of the VC funds that they've raised capital from, maybe they had some foreign ties that we aren't aware of. So maybe that could be part of it. Foreign ownership in the company. Employees with ties to foreign countries could result in a flag. Certainly any foreign vendors on projects are likely to be unallowable and would trigger this. So there is a list of what would cause the foreign risk. But again, companies just don't know what's causing it in their situation. I think we can all agree that it's really important that we protect American innovation and make sure that it's not that companies aren't able to under foreign influence, but it's also important that these policies are administered in such a way that it's not penalizing the small businesses here, and that we're not giving our foreign adversaries, if you will, a chance to accelerate their own R&D while we're kind of hampering ours. So
yeah, right.
I think it's a well-intended policy, but as it goes with a lot of policy changes, there's going to be kinks in the policy and the way that it's implemented. And so that's why it's important that legislators have awareness of how this is actually affecting companies, boots on the ground, if you will.
Yeah. Okay.
And so I think it's important that like for us at NC Biotech, we're just trying to raise awareness of how this piece of a well-intended policy may be resulting in some negative consequences for early stage companies and innovation in the United States. And so I'd recommend, for companies to do what we do. So we're a nonprofit. We're unable to, go out and ask for specific things from congressional representatives, but we work with trade organizations like NC Bio here in North Carolina, who's been doing a lot of great work on this. The bigger bio organization on the national level has been trying to bring awareness to this situation. The Angel Capital Association, National Venture Capital Association, and others are all also aware of this. If you're a company, you probably have interaction with a trade association. So if this is something that's important to you, you could talk to them about what you can do to help build awareness of the challenges that you might be facing. But we're going to, continue to be available to educate and answer questions about how we're seeing this impact companies. But again, like the trade organizations are really asking for increased transparency, opportunity to appeal, due process for companies that are flagged for this, because ultimately, if you do have a foreign risk in your business, it would seem to be important that you know what that is and that you have an opportunity to remedy that and protect your company's interests.
Yeah, right. Well, Mike, thank you for flagging it. I hope these educational efforts pay off and that people do now know more about this, and then potentially that it might get solved in the future. Hopefully the companies that did get denied either were able to reapply or were able to find some financing from somewhere else. But thanks for the work you do on helping them do that.
Absolutely. Thanks, Paul. And really appreciate the opportunity to join your podcast today.
On this next snippet, we're going to talk with Ben Glenn, who is Venture South's tax advisor, does all the tax work behind the scenes at Venture South, and does a lot of work with startup companies and startup investing. And so is well versed in some of the questions that we're going to tackle here. If you look back to episode 12, David and I gave a thorough overview of tax issues for angel investors to consider. One of the more appealing benefits of early stage investing is qualified small business stock. And Ben is going to walk us through some of the changes to the rules of qualified small business stock in this next segment. On this segment, we are talking with Ben Glenn, who is a very experienced tax accountant, among other things. And he's going to give us a quick overview about the changes to qualified small business stock that came about in the Big Beautiful Bill and the recent changes along with that. So Ben, welcome back to the show.
Sure. Thank you, Paul.
Maybe we could just give listeners a quick intro to your background, just to learn who they're learning from.
Sure, absolutely. My name is Ben Glenn. I'm a tax partner at Balknight Peterson Stormer. We're a CPA firm located in Columbia, South Carolina. I've been with the firm for about going on 20 years now, and specialize in quite a few areas, one of them being early stage startup entities and venture investing, angel investing, sorts of.
Great. I wanted to ask you on the show today, just so you can give us a little bit of an overview, maybe just generally about qualified small business stock, but also specifically about what's been going on recently. So I'll hand the floor to you.
Sure, yeah. And small business stock's been around for a while. There's been an update, as you mentioned, with the One Big Beautiful Bill that was just passed in July of this past year. What qualified small business stock is, it's under the Section 1202 of the Internal Revenue Code, and it's a special tax incentive that's designed to encourage investment in these early stage small growing companies in the U.S. There are a few key requirements that qualifies stock for qualified small business stock. The stock must be issued by a domestic C corporation. This is usually one of the big items that will trip people up because C corporations in general aren't overall that popular of an entity type. For early stage companies, they will usually gravitate more toward flow through type entities as corporations and partnerships. But the stock does have to be issued by a domestic C corporation in certain industries. Tech, manufacturing, and retail all qualify for the industries, but professional services like law, health, finance, and unfortunately accounting don't qualify for the qualified small business treatment. And stock must be acquired on direct issue from the C corporation. It cannot be acquired, secondhand. And there's a certain holding period that you have to have. I'm going to be a little fuzzy on some of the numbers up front because there was a change. So I do want to give everybody a good before and after the One Big Beautiful Bill. The company has to be of a certain size, and you have to hold the stock for a certain amount of time, and it excludes a certain amount of income. We'll get into the details on that later, but that's a general overview of Section 1202.
Got it. And so at a very high level, if you hold it for a certain amount of time, it's the right stock. You hold it for a certain amount of time, and it's not too big when you bought it, your capital gains tax is eliminated on that gain if there is one.
Correct. Yeah. Correct. There's 100% gain exclusion on the sale of qualified small business stock, which adds up to around 23.8% on the federal level. You have the 20% capital gains tax, and then you have 3.8% of the net investment income tax that gets you to 23.8. Many of the states as well will also allow for the qualified small business stock and the gain exclusion. You just have to know which ones that you're dealing with and double check with your accountant to make sure.
Yeah, most of the states in the Southeast, I think, do. So that's good news for the Southeastern investors.
Absolutely, South investors, and that is very good news. Correct.
Yeah, and so can you just give us the numbers for the before and after? What did the bill change?
Yeah, absolutely. So what the One Big Beautiful Bill did is it really supercharged the effects of qualified small business stock. So you mentioned the gross assets threshold. So the company cannot be over a certain value at the issuance of the stock and directly after. So the threshold was $50 million prior to the One Big Beautiful Bill. After the One Big Beautiful Bill, it is now to $75 million. So this really opens things up on the back end for mid-stage startups. It doesn't have to be quite so early stage. So you get into Series B, Series C issuances on some of these qualifying entities. If they're in the correct industry, you can get up to an additional $25 million of assets at the point of issuance and directly after it and have it still qualify as qualified small business stock.
Okay, got it. So slightly bigger companies it applies to. That's good. What else?
Correct. Yeah. And the gain exclusion, the important part of it is that's moving up from $10 million to $15 million. So to the One Big Beautiful Bill, it was $10 million of gain exclusion. That's gain exclusion. So not your gross sales price, the amount of gains you have, you could exclude $10 million or 10 times your basis. Under the new qualifications under the One Big Beautiful Bill, it's the greater of $15 million or 10 times your basis.
Okay, got it. So in situations that are very good outcomes, I think most angel deals aren't going to give you as an individual 10 million of gains on one deal, although I guess it could.
If you qualify, if you are maxing out your gain under qualified small business stock under 1202, you had a very good day. Period. But being able to save, just a simple math, under a $10 million of gain, it's a $2.38 million of tax that you would have paid under your federal taxes you're saving. But that's before you get into state income tax that you're saving as well. So it's a very significant benefit.
Yeah.
The last part was the holding period has been adjusted as well. Prior to the One Big Beautiful Bill, there was a 5-year holding period to receive that full 100% gain exclusion. And they've moved from that to a tiered system where you have, if you own it for at least 3 years, you get 50% gain exclusion. In 4 years, you get 75% exclusion. And then 5 years, you get 100% gain exclusion.
Okay, got it. So that one actually probably does impact quite a lot of people because there's a lot of early stage companies that sell quickly, perhaps less than 5 years. So that you used to not be able to get this full benefit, but now you can get at least some of it.
Correct. It takes that cliff aspect out of it. So 3, 4, and 5 years, 50%, 75%, 100% gain exclusion. Still a very significant benefit. What I always tell my clients is you don't want to let the tax tail wag the dog, right? So if you have the opportunity to have an exit and exclude 50% of the gain, I would be very careful before you say, well, let's just roll it another 2 years so I can exclude 100% of the gain. So if you're getting a very good exit, and you're getting 50% or 75% gain exclusion, just don't sneeze at that or balk at that and think that you're not getting quite a good deal. You don't want to let the tax tail wag the dog.
Yeah, got it. I guess it's worth noting that this just applies to investments made after July 4th of this year.
Correct.
Right?
Say One Big Beautiful Bill, that is for the stock acquired after July 4th of 2025. So if you acquired it prior to July 4th, 2025, you're under the before One Big Beautiful Bill rules.
Okay, great. There's some other things to dig into in a bit more detail, but one interesting implication is what happens to what we used to do where we rolled over the gains under 1045 if it was held for less than 5 years. Can we still do that? Or does this extra math make it harder to figure out what to do in these situations?
Well, it gives you some different things to consider. The code section there is section 1045. I don't want to inundate people with code sections, but if you were going to ask your tax advisor, 1202 and 1045 would be the code sections that you would mention. What 1045 does allows you to roll your gain into a new qualifying small business investment. Think about a like-kind exchange. It's pretty much the same thing as a like-kind exchange. You're just rolling your investment, deferring your gain, putting it into a new qualified small business. Now, the good news is that you can tack on your holding period from the prior investment into the new investment. So that 3, 4, 5 year holding period that I mentioned prior, you're tacking that on. And so if you were under that scenario, let's say you had an exit at 3 years and you're getting 50% gain exclusion, and you had the opportunity to roll that into a new investment that also is qualified small business stock, that's where you might want to think about taking advantage of 1045, rolling into a new investment, then getting to a 5-year hold period, and then getting to that 100% gain exclusion.
Got it. Okay. Definitely one to talk with your tax advisor about, depending on what your situation is. So I guess that's the usual encouragement is to go do that.
Correct. And that brings me to one of the last things I wanted to make sure I mentioned is that you should definitely discuss this with your tax advisor. I would advise all the taxpayers or the investors that are listening to the podcast to discuss this with your tax advisor, but to take ownership of this issue. Learn about it, read about it, contact your tax advisor. But I would make sure that you know these things on the front end, whether or not it qualifies or not. So at the point of your investing, this is something you need to know at the front end of, does this qualify for under 1202 or does it not? And make sure you're asking that before you get into the investment.
Yeah, right. There's actually some paperwork you can probably get done at the time of the investment to make it easier to prove that later. And you probably want to do that at the beginning rather than wait till the end.
It's always easier to take contemporaneous notes, contemporaneous conversations, get comfort from the company you're investing in that it does qualify under 1202 before you do it. It's much easier to do that now at the point of investing rather than try to create that paper trail, 5 years later. It could still qualify, but it's a lot easier to have that in your file now rather than try to go and get that information later at the end after you've exited.
Yeah, right. Okay, Ben, thank you. I really appreciate you giving us that very clear update on how things have changed, and good luck with your tax advising going forward.
Absolutely. Enjoyed it. Thank you very much.
Okay. Thanks, Ben. I appreciate your input there. David, I'm going to hand back over to you and me now to chat a little bit about what we think about the changes to QSBS and whether it really impacts what we do as early stage investors. So, David, over to you.
Well, I think what it really does is it makes the package a little bit more attractive, and it does that by making it a little bit easier to benefit from an exit before 5 years. And so you get a fractional benefit. And I think that's significant. I wouldn't minimize that at all because there are some rapid exits that we see that are attractive and profitable. And so you have significant gains that you would like to exclude. And then the other main issue that he discussed was the per issuer gain exclusion cap. I think they expanded to 15 million or 10 times a taxpayer basis. And so from an investor perspective, that just sweetens the pot.
I think you're right. I think it's pretty unlikely that an individual angel investor investing 5 or 10 grand in a deal is going to have a $15 million gain on something. So from an investor perspective, that one doesn't seem super exciting to me because it seems unlikely we'll use it very much. That potentially is significant for founders because they own more of the company. So with very successful startups where the founder can benefit from QSBS, that would be a nice extra gain before you start worrying about capital gains taxes. But I agree with you on the graduation, the 3-year time frame to start getting some QSBS exclusion. That fits actually really nicely with the Southeastern investment thesis and early exit strategy that we talk about on the show, because one of the downsides of selling early was you lost your QSBS benefit. But if you now sell in years 3 and 4, you don't get all of it, but you get some of it. So that makes an early exit slightly more palatable than holding on for longer.
Yeah, that's exactly right. And overall, the QSBS is probably one of the most attractive tax benefits available to any investor that's, investing personally, at that scale.
Right.
And, if you're a major investor, you invest a significant amount of your equity into startups. This is huge. I mean, this can generate tax-free revenue for you, lower your tax rate, and that can't be underestimated.
Yeah, there's not many assets you can invest in ever that don't generate capital gains tax when you make a gain. And startups, QSBS is pretty much the only one. So yeah, I agree with you. It's a very favorable tax situation to be in. Okay, well, our third topical topic for the show is this controversy around H1B visas. So just to recap for viewers if they aren't familiar with it, the Trump administration put a $100,000 fee onto an application for a new H1B visa application. These are visas for foreign workers to come in a specialized field to take the job in the US for the employer. These are often, although not exclusively, tech-focused roles. And so a lot of this affects the wider tech community. So we thought I know it's a politically charged subject, but I thought we'd at least try to talk about it a little bit on the show and see what the views were on basically how important this appears to be to the Southeastern startup scene. With that background, David, I might turn it over to you to see how you think about this issue and whether you think it's a big one for the startups you work with.
Well, from my perspective, it's mostly a non-issue. I don't think it's going to affect early stage where we focus, even beyond early stage. So early growth, I don't think it's going to affect them very much. I mean, there is some use of H1B visas in that cohort, but it's mainly big enterprises that utilize this, and they have a coordinated program to sign up, 100 H1B employees. And so I don't think it's going to deter them because they save so much money hiring these experts from outside the country. But the other aspect is that there are a number of other visa programs that startups can use to bring in talent. And I don't know all of them. I'm not familiar with them all, but don't assume just because the H1B has had a tax put on it that there's not other ways to bring in talent into the country. And I think the reality is that the current administration is likely to be pretty responsive to business interest in hiring external talent as a way to develop an immigration policy that will allow talented people that we want in the United States to get green cards. And so I think what we're looking at is probably the evolution of a immigration policy that's going to start out as a specialized visa and evolve into a green card for that individual.
Yeah, it's hard to know exactly what the plan is.
I don't know that there's a plan. I'm just talking about the political momentum.
Yeah, well, right. It might be an inadvertent plan, but yes, it does seem to me that this isn't a huge issue to the startups I work with either. I hear a lot about H1B visa applications from our portfolio companies. It does seem to be that the bigger players and some of the sort of IT consultancy outsourcing firms that really use a lot of these at scale have a bigger interest in these than early stage startups. So it wasn't one that I was too worried about, from a professional level. One thing I did notice, though, during all the sort of discussions about it was there was a study done a few years ago about the impact of an H1B visa. I don't know if you saw that study.
No.
David? It was a pretty interesting study. So it said that, or it made the pretty grand claim that if you were lucky in a H1B visa lottery, which is the way sometimes these visas are given out, you got one H1B visa employee out of it, you had a 23% higher probability of getting to an IPO. I mean, I can see how getting better employees gets you a better company. So if that is what happens, then I can see some slight causal mechanism. But that has an absolutely massive impact on the probability of a company getting to an IPO. That just can't be right.
I think it's the enriching of the pool. So those companies that can afford to bring in H1B visa holders they're better funded, they're larger, and their odds of success are greater because of that.
Right. That's a much more plausible causal statement. This paper was actually pretty clear, though, that the cause was just having that person led to a 23% higher chance of IPO.
Yeah, that's an association, not causal.
Yeah. So it was an interesting study. I don't believe it. I agree with you. I just don't believe the size of that impact. So it sort of don't need to explain it because that impact can't possibly be right.
Yeah.
But I thought it was an interesting piece of science that sometimes we talk about these NBER academic papers on the show about how these studies are done on various bits of angel investing. And I thought that was an interesting one just because the conclusion there was so outlandish.
Yeah.
Anyway, yeah.
I've said it before, my level of confidence in published scientific papers is low. And the reason is that it's the old adage that, show me the incentives and I'll show you the outcome.
There was another paper that basically said there was no impact at all from H1B visa recruitment. And, usually it's easy to publish something with a big positive result than it is a result that says there really isn't anything here.
Exactly.
They do sometimes present both sides.
Yeah, when I was in training in medicine, we used to joke a lot about the Journal of Negative Results as the cesspool for science that didn't have a positive results. How do you get benefit out of that as a academic? And you have to publish it somewhere. So we had this fictional journal of the Journal of Negative Results.
Yeah, actually, I think that would be an important journal to have. It's
well, there is a journal now that does
true.
that. They focus on negative results.
Okay, cool. Yeah.
So it's not widely consumed though.
No, well, yeah. Okay, well, those are three topics to talk about in the angel investing world this week. I don't think any of them dramatically change what we do as angel investors, but always good to know what's going on in the world. So thanks, David, for walking through those, and we'll see everybody next week.
Thanks, Paul.
Thank you for listening. Visit us at ventureinthesouth.com for a complete list of previous and future shows.